So last week we saw Bank of Canada announce their another rate hike by 25 basis point, and they also announced they're taking a pause. And since then we have seen some activity in the housing market. But this week Federal Reserve is going to announce their monetary policy and what it means to the overall global economy and also Canadian economy going forward. We will touch upon this all in this video, so stay tuned till the end. Alright, welcome back. My name is Yasin Nizami and I make these videos to educate my audience about the real estate market in Canada, particularly in the GTA, as well as some macroeconomic, some geopolitical situations, some investing strategies. So if you're interested in any of these topics, consider subscribe and let's get back to our topic of the day. Now, last week we saw Bank of Canada announce their overnight rate hike by 25 basis point. It's the 8th consecutive rate hike since last year we have seen, and they also announced they're taking a pause, which means it's a conditional pause, which means they're going to assess the economic situation before making any decision about the future rate hike. It's quite possible that they will continue raising rates again if the data that they wanted to see doesn't come as per their expectation. So what is the data? Number one is the CPI, and number two is the unemployment data as well as the GDP. So if the CPI doesn't come down, then they will have to think about it, continue raising the rates. If the GDP contracts, if the GDP comes down to the negative level, then of course it's recessionary, which means they will have to put their foot off the gas pedal. And the unemployment data right now, it is below 5%. If the unemployment goes up to, let's say, 6 or 7%, then of course that's a trigger that will have to reassess the decision and then perhaps start cutting down the rates. Since then, we have seen some activity in the housing market. A lot of people who were sitting on the sidelines, especially the buyers, they're not jumping into the market and thinking maybe this is the bottom, and then from here the market will start going up gradually. I will take very precautionary strategy here because this could be a bear market rally. Now, because rate hikes are paused, yes, but that doesn't mean that it's going to come down anytime soon. So if the rates stay at that level, which means the stress that the households are experiencing in terms of their financial expenses, that is not going to come down anytime soon, right? And if you wanted to assess that level of financial stress, take a look at this tweet somebody posted on Twitter, and what they have shown is how the interest rate hikes have caused financial trouble in terms of their monthly mortgage payments since December 2021. So from $3,772 a month to $6,230. That's the level of impact an average Canadian is having, considered they have taken variable rate mortgage in the last 2 years. And I am among those people as well, because nobody expected this aggressiveness of the rate hikes in the last year or so. I mean, I knew that the rate will have to go up from there, but then I was expecting it's going to be 25 basis point every quarter, not like 400 basis point in 3 quarters. So that, I think pretty much a lot of people have misread that strategy from Bank of Canada, and now we are paying the price in terms of higher mortgage payment. What I believe is the CPI will come down very, very quickly. And I wrote a Twitter thread as well on that. And my thesis is that if you look at the monthly data on the CPI, that's Stats Canada's reading, last 6 months data, it is averaging out at 2% already. Okay, and the reason is the gas prices have come down from their peak because the oil prices in the market, in the global market, has come down from the peak as well. And that is one of the major bucket in the CPI, the way the Stats Canada measures CPI. And if it continues to stay at the level, then of course we will see CPI coming down very, very quickly. And the other thing is, when Bank of Canada was raising rates, it's also kind of increasing the shelter cost directly or indirectly. If you look at this chart, you can see that as Bank of Canada was raising the interest rate, it was also contributing in terms of increasing the shelter cost, because the way Stats Canada measure the shelter cost in the CPI, it takes both of the measurements. Number one, the rental payments as well as the mortgage interest payment. And if this chart shows that, as the Bank of Canada increased the rates, the mortgage interest payment has also spiked exponentially from April 2022 onwards. So it was kind of counterproductive per se that, as Bank of Canada was raising the interest rate, it was also increasing the shelter cost, which is also one of the heavier factor or heavier weightage in the CPI basket. The other reason why Bank of Canada might be thinking about stopping the rate hike is if you look at the debt level situation in Canada. You have a Canadian federal government debt which is already too high, we know that. But Canadian government has an advantage to print money and inflate the debt away, right? They have always this option available, and most likely they will do that anyway. But if you look at the common person, the individual, the Canadian household, the debt to GDP ratio right now from a household perspective is 183%, which means if you're earning $1, you will have to pay $1.83 in the debt. Plus, the private sector debt has been also record breaking. If you look at this chart, that shows you how Canadian private sector debt has gone above the Japanese private debt peak that we saw in the 80s. You know what happened in Japan in the 80s, right? Similar economic boom as a result of residential real estate investment. It was going crazy, and then finally the bubble burst, and then we saw a decades-long recession, which Japan hasn't even recovered from it today. So this is food for thought for you guys to understand how the economic situation from a debt perspective is so dangerous in Canada. Even a 25 basis point rate hike is going to cause a lot of financial trouble for these private sector businesses, which will be forced to cut down their spending from an OPEX perspective, which means that will result into job losses and also reporting earning loss in the stock market, which will also reduce their stock valuation. So there's a lot of downside risk from a debt perspective, and every rate hike is going to cause enormous financial trouble for these businesses as well as individuals as well. So that's another reason why Bank of Canada is rethinking to take a pause and maybe try to balance the approach from bringing down the inflation a little bit and then not to trigger a recession, because that will be very, very painful for a lot of Canadians, household as well as businesses alike. So this week we are going to see Federal Reserve is going to announce their monetary policy, and the market is expecting another 25 basis point. But is it going to be a pause or not? I think there's a mixed opinions, but my personal analysis is that I think Federal Reserve will also try to not to shock the market. So they will come as a neutral person in that sense, that they will say, okay guys, we are continuing to increase 25 basis point, and then we will also assess the situation in our next meeting by looking at the fresh data in terms of unemployment numbers, the GDP, as well as the new CPI readings. Because if you look at the same last 6 months CPI data from BLS, that is also showing a sub 2% CPI figure already in the last 6 months. We saw that since Bank of Canada announced the interest rate hike, the spread between the variable interest rate and the fixed mortgage rate is approaching to 1%. So this chart shows you the historic trend. Typically, the variable rate tends to be lower than the fixed mortgage rate, but what we are seeing right now is the fixed mortgage rate is falling behind the variable interest rate. So variable interest rate is sitting at close to 6%, and the fixed mortgage 5-year rate has come down, below 5%, somewhere close to 4.6, 4.7, depending upon the lender. And because the reason is the fixed mortgage rate is tied with the Canadian 5-year bond, and the yield on that bond has come down from its peak where it was approaching 4% last year. Now it has come down to close to 3%. And the expectation is if the yield doesn't spike anymore, fixed mortgage rate will also come down very soon. So I think it's a very interesting market because we don't have inventory. So we are seeing some bidding offers, some nicer houses are being sold over asking. Because the buyers have they don't have any choice to choose from. So the inventory is super thin, and the nicer houses are being sold very quickly. But as the inventory build up in the spring market, this is where we will see the real impact of this monetary policy on the housing side, because if the inventory goes up and we don't have enough demand because of the rate hikes, then it will put a price pressure downward in the spring market. So more to see. We will have to assess the data. We will have to see how Federal Reserve is going to increase their monetary policy rate and how this is going to impact the stock market in the US as well as the housing market. That's it for me today. If you like it, give me a thumbs up and hit subscribe and share, and put your comments down below. If you have any questions or comments, I'll be more than happy to take your input as well to refine my video content. So until next time, take care.